Lock in for the next few minutes because what I am about to share with you is not speculation, not theory, and not another market commentary piece. On February 5th, 2026, at 2:47 p.m. Eastern Time, the overnight repo market experienced a liquidity event that sent shockwaves through institutional trading floors in New York, London, and Tokyo. Repo rates, the cost for banks to borrow cash overnight using Treasury securities as collateral, spiked uncontrollably. This wasn't just a glitch, it was a fundamental breakdown in the plumbing of the global financial system. As liquidity evaporated, the spread between the bid and ask for high-quality collateral widened to unprecedented levels. Traders watched in disbelief as screens flashed red, signaling a crisis that few were prepared for. The implications of this event are far-reaching, affecting everything from short-term lending to the stability of major currencies. We are witnessing a pivotal moment that could redefine market dynamics for years to come. Stay focused as we break down exactly what happened and what it means for your portfolio. Collateral spiked from a normal range of 4.5 to 4.8% all the way up to 9.2% in a matter of hours. This is not a crash. This is not panic in the traditional sense. This is something far more dangerous. This is the plumbing of the global financial system seizing up. And what makes this different from every other market hiccup you've seen in the last 5 years is that the Federal Reserve's emergency liquidity facilities, the same mechanisms that prevented complete meltdown in March 2020, and again in March 2023 during the Silicon Valley Bank crisis, were accessed by 14 institutions in a single trading session. 14. That number has not been reported in the financial press because it's buried in the Federal Reserve Bank of New York's operational data that gets released on a 48-hour delay. But the institutions know, the trading desks know, and the smart money is already repositioning. The repo market is a $4.6 trillion overnight lending market that most people have never heard of, but it is the absolute foundation of how banks, hedge funds, and institutional investors manage their short-term cash needs. When this market freezes, when the cost of overnight liquidity spikes by 200% in a single afternoon, it means one thing. Major financial institutions are desperate for cash, and they're willing to pay any price to get it. Over the next several minutes, I'm going to walk you through exactly what happened on February 5th, why this is a structural break and not a temporary dislocation, how this connects to the $6.8 trillion in Treasury securities sitting on bank balance sheets at unrealized losses, and most critically, the 3 asymmetric plays you need to understand right now to protect your wealth and position yourself for what comes next. This is not about fear, this is about pattern recognition, preparation, and understanding that what happened in the repo market this week is the same warning signal. We saw 90 days before the Lehman Brothers collapse in 2008, and 60 days before the European sovereign debt crisis escalated in 2011. Before we dive into the mechanics of what happened on February 5th, you need to understand the framework that governs every major liquidity crisis in modern financial history. Financial markets do not operate on fundamentals alone. They operate on the availability of cash, the velocity of that cash, and the willingness of counterparties to lend to each other. When any one of those 3 variables breaks down, the entire system can seize in a matter of hours, regardless of the underlying economic fundamentals. The repo market is the most critical piece of this puzzle. Repo stands for repurchase agreement. Here's how it works in the simplest terms. A bank or hedge fund has Treasury securities on its balance sheet, let's say $100 million worth of 10-year Treasuries, but they need cash today to meet margin calls, to fund trades, or to settle obligations. They go into the repo market and they sell those treasuries to another institution, typically a money market fund or another bank, with an agreement to buy them back the next day at a slightly higher price. That difference in price is the repo rate. It's effectively an overnight interest rate on a collateralized loan. When the system is functioning normally, repo rates track very closely with the Federal Reserve's policy rate. Right now, that's around 4.5%. Banks can borrow overnight at that rate, plus or minus a few basis points, and everyone goes home happy. But when repo rates spike, when they suddenly jump to 7, 8, 9% or higher, it means that lenders are either running out of cash to lend or they don't trust the collateral being offered. And in a Treasury-backed repo market, the collateral is supposed to be risk-free. So when rates spike like they did on February 5th, the message is clear. The system is under stress and institutions are hoarding cash. This is the exact same pattern we saw in September 2019 when repo rates spiked 10% overnight, forcing the Federal Reserve to intervene with hundreds of billions in emergency liquidity. It's the same pattern we saw in March 2020 when the COVID crisis hit and repo markets froze entirely, requiring the Fed to inject over $1 trillion in a matter of days. And it's the same pattern we saw in March 2023 when Silicon Valley Bank and Signature Bank collapsed and regional banks suddenly couldn't access overnight funding. We are witnessing the early stages of a liquidity crisis driven by a toxic combination of unrealized losses on bank balance sheets, rising Treasury yields that are destroying bond portfolios, and a Federal Reserve that is trapped between fighting inflation and preventing a financial system collapse. This liquidity stress will create three asymmetric opportunities in short duration cash equivalent plays, in precious metals as a zero counterparty risk asset, and in deeply distressed financial sector trades for those with the stomach to time the bottom. Let me explain how the unrealized loss problem works, because this is the quiet mechanism that makes the February 5th repo spike so dangerous. When a bank buys a Treasury bond or mortgage-backed security, it books that asset at par value on its balance sheet. If the bank buys a 10-year Treasury bond yielding 2% and holds it to maturity, everything is fine. But if interest rates rise, the market value of that bond falls. A 10-year Treasury yielding 2% is worth significantly less in a market where new 10-year Treasuries are yielding 5%. The bank hasn't technically lost money yet because it plans to hold the bond to maturity. But if the bank needs to sell that bond to raise cash, it has to sell it at the current market price, which means it takes a realized loss. According to the Federal Deposit Insurance Corporation's most recent data, U.S. banks are sitting on approximately $6.8 trillion in securities, and a significant portion of those are underwater due to the interest rate increases from 2022 through 2025. This is not a secret. It's disclosed in regulatory filings, but it's not a problem until it becomes a problem. And it becomes a problem when banks need liquidity fast. Now let's connect this to what happened on February 5th. According to the Federal Reserve Bank of New York's repo operations data, which is published with a 48-hour delay, the overnight repo rate spiked from its normal range of 4.5 to 4.8% up to 9.2% in the afternoon trading session. At the same time, the Federal Reserve's standing repo facility, which is an emergency backstop for banks that cannot access funding in the private market, saw usage from 14 institutions in a single day. That is the highest number of institutions accessing that facility since March 2023 during the regional bank crisis. The Federal Reserve has not disclosed which institutions accessed the facility. That information is kept confidential to prevent panic. But we can infer from the repo rate spike and the volume of transactions that several large institutions were scrambling for cash. Why would institutions be scrambling for cash? There are three possible explanations, and all three are bad. The first explanation is that a major institution, or multiple institutions, are facing margin calls or redemptions that require immediate liquidity, and they can't sell their Treasury or mortgage-backed security holdings without taking massive losses. So instead, they're borrowing in the repo market at any rate they can get. The second explanation is that counterparties in the repo market are pulling back because they're worried about the creditworthiness of borrowers. Even though repo loans are collateralized by treasuries, if the borrower defaults, the lender has to sell the collateral in a falling market, which could result in a loss. So lenders are demanding higher rates to compensate for that risk. The third explanation, and this is the most systemic, is that there's a shortage of cash in the system overall. The Federal Reserve has been running quantitative tightening, meaning it's been shrinking its balance sheet and pulling liquidity out of the system. At the same time, the Treasury has been issuing massive amounts of new debt to fund deficits, which absorbs cash from the financial system. If the supply of cash is shrinking and the demand for cash is rising, repo rates spike. All three of these explanations point to the same conclusion. The financial system is under liquidity stress, and that stress is accelerating. A repo market seizure doesn't stay contained in the overnight lending market. It spreads. When banks can't access cheap overnight funding, they pull back on lending. They tighten credit standards. They reduce lines of credit to businesses and consumers. This is how a liquidity crisis in the repo market translates into a credit crunch in the real economy. We're already seeing early signs of this. Commercial and industrial loan growth at U.S. banks has slowed to near zero on a year-over-year basis, according to Federal Reserve data. Credit card charge-off rates are rising, auto loan delinquencies are rising, and commercial real estate lending is effectively frozen. Now, layer on top of this the fact that the Treasury is still issuing over $2 trillion in new debt annually to fund the federal deficit. That debt has to be absorbed by the market, and if the market is facing a liquidity crunch, yields have to rise to attract buyers. But rising yields make the unrealized losses on bank balance sheets even worse, which creates more liquidity stress, which forces more repo borrowing, which spikes repo rates even higher. This is a feedback loop, and once it starts, it's very difficult to stop without massive central bank intervention. So what are the three asymmetric plays in this environment? The first play is cash and cash equivalents in the safest possible vehicles. I'm talking about Treasury bills with maturities under 90 days, money market funds that invest only in government securities, and FDIC-insured bank accounts well below the $250,000 insurance limit. The reason this is asymmetric is because in a liquidity crisis, cash is king. When everyone is scrambling for liquidity, the people who have cash can buy distressed assets at pennies on the dollar. This is how smart money made fortunes in 2008 and 2009. They held cash through the crisis and then deployed it when assets were being liquidated at fire sale prices. The key is to avoid duration risk. Do not be in long-term bonds or bond funds right now, because if yields continue to rise, those will get crushed. Stay short, stay liquid, stay safe. The second play is physical gold and silver as a zero counterparty risk hedge. In a liquidity crisis, the weakest link is always counterparty risk. Your bank deposit is a liability on the bank's balance sheet. Your bond is a promise from the issuer. Your brokerage account is a claim on securities held by a custodian. All of these have counterparty risk. Physical precious metals have zero counterparty risk. When you hold physical gold or silver, you own final settlement. There's no intermediary. There's no institution that can freeze your account or fail and take your assets with it. Historically, gold performs extremely well during liquidity crises. In September 2008, after Lehman collapsed, gold fell initially as institutions liquidated everything to raise cash. But within 3 months, it was making new highs as investors fled into safe haven assets. In March 2020, the same pattern played out. Gold dipped briefly during the liquidity scramble and then rallied over 40% in the following months. The move here is to allocate a meaningful portion of your portfolio, at minimum 10 to 15%, into physical gold and silver that you hold outside the banking system. Not ETFs, not futures, not unallocated accounts. Physical metal in your possession or in fully allocated segregated storage. The third play, and this is for those with higher risk tolerance and the ability to time entries, is distressed financial sector equities and credit. When a liquidity crisis hits, financial stocks get destroyed. Banks, broker-dealers, asset managers, insurance companies, they all sell off indiscriminately. But not all financial institutions are created equal. Some have fortress balance sheets, low leverage, and strong liquidity positions. These institutions will survive the crisis and will trade at depression-era valuations during the panic. This is the exact playbook that made Warren Buffett billions in 2008 and 2009 when he bought Goldman Sachs and Bank of America preferred shares at distressed prices. The asymmetry is that you're buying high-quality institutions at prices that assume bankruptcy, but the reality is they will survive and thrive once the liquidity crisis passes. The key is to wait for the panic. Don't try to catch a falling knife. Wait until repo rates have spiked even further, until we see forced liquidations, until the Federal Reserve steps in with emergency measures. Then you deploy capital into the highest quality names at the lowest prices. Now, let us talk about the forward-looking indicators you need to be watching, because this situation is evolving in real time. The first indicator is the Federal Reserve's standing repo facility usage, which is reported with a 48-hour delay on the New York Fed's website. If we see usage continue to climb above 10 institutions per day, that tells us the stress is not subsiding, it's intensifying. The second indicator is the SOFR spread, which is the secured overnight financing rate compared to the Federal Reserve's target rate. SOFR is the benchmark for repo transactions. If the spread between SOFR and the Fed's target rate continues to widen, that's a sign that the private repo market is under sustained stress. The third indicator is Treasury bill yields at the very short end of the curve, specifically the 1-month and 3-month T-bills. If those yields start spiking relative to longer maturities, it's a sign that institutions are desperate for short-term cash. The fourth indicator is credit default swap spreads on major banks. CDS spreads measure the cost of insuring against a bank default. If those spreads start widening significantly, it means the market is pricing in higher default risk. Here's the question I want you to answer in the comments. Do you believe the Federal Reserve will step in with emergency liquidity measures in the next 30 days? Or do you think they're going to let this play out to bring inflation down, even if it means breaking something in the financial system? I'm genuinely curious because the debate in the macro community right now is intense. Some analysts believe the Fed will pivot at the first sign of real systemic stress. Others believe they have learned from the mistakes of 2008 and 2020, and they're willing to let institutions fail if it means restoring credibility to monetary policy. If you found this breakdown valuable, subscribe to Rizan Historic and turn on notifications, because I'm going to be tracking this repo market situation daily as it develops. This is not a one-time event. This is a process, and you need to be plugged into the data as it comes out. The repo market seized on February 5th. Wall Street is panicking quietly. The emergency liquidity facilities are being accessed at levels we haven't seen since the last crisis, and your portfolio positioning in the next 30 days will determine whether you come out of this ahead or whether you're part of the collateral damage. This is not about fear. This is about preparation, pattern recognition, and making informed decisions with your wealth. The liquidity cascade has started. The only question is whether you're ready for what comes next.